What I can show you is I can show you a short period of time where you invest a lump sum investment just before a large downturn compared to dollar cost averaging over a 3-year period during a known downturn, right? So this is just one example. Of course, it works the other way, where if you put the $10,000 in a bull market at the beginning of a bull market, there are many multiples of growth there. But
by the way, Craig, I think you're onto something here in terms of looking at it this way, because what I have seen where the question of do it all at once, lump sum, or dollar cost average, that question basically comes when somebody has an inheritance or they've sold a house, they want to invest the money. And so they're trying to figure out, do I just put it all in, or do I dollar cost average in, or do I do some of it lump sum and some dollar cost average? So you're really kind of addressing in a way that person who's got a large amount of money to deal with all at one time. And I think that's a good question to solve.
And that's only one example of a dollar cost averaging. I really wanted to note that the $1 million difference is regular saving, right? Yeah. And so if you can set up something that's automatic, if your employer helps you set up something that's automatic and your matches are automatic, that is the $1 million difference. That's I want to say guaranteed, but I can't say guaranteed, right? Yeah. And so this actually is a good point. Automatic savings and your savings rate. So how much of your disposable income do you actually save? Sometimes it's 10%, sometimes it's 5%. Some people on the extreme end of things save 50 or more % of their disposable income. And they get to these numbers much more quickly than those who are saving less. But again, that automatic, set it and forget it savings is the true $1 million difference.
Can we drop it right there? Or do you want to show it?
Well, I wanted to show
you go.
Yeah,
go.
sure.
Great.
So I'll go ahead and share the screen. And again, I've got the two windows open. And in the first window, I'm starting in 1973 because there was that was the beginning of a downturn. And so in this first one, I'm going to simulate a starting value of $10,000. And starting in 1973, over a 40-year period, I'm putting $10,000 in once at the very beginning of 1973. That's right before two large downturns. So at the end of 1974, that $10,000 lump sum is down to $6,270 here. But it grows to $410,000 if left untouched in this example. Mm-hmm. All right, I'm going to flip over to the other window. And in this one, again, starting in 1973, my starting value is $0, but I'm going to contribute $3,333 for each year for 3 years. So my contribution amount is 3,333, and my contribution duration is 3 years, starting in year 1. So that contribution, basically in 1973 and 74, because you dollar cost averaged, you're buying things much more cheaply, right? And so that turns into $515,000. And I'm going to flip back to the other screen compared to $410,000.
Yeah.
Just that very small, because you're buying these things cheaply in the second year, you've invested $6,000 and you have $4,000 at the end of year of 1974. But because you purchased them during that year, it comes roaring back, and the return rate because you purchased them in that year is 64%, compared to a 37% return if you would have done the lump sum investment of $10,000.
Well, I will tell you that that idea of just creating a discipline that is absolutely mechanical. One piece of information that helps us know that it works is that one of the most profitable investments ever made by the individual investor was target date funds, and they do it every month. They don't have to pick anything. I mean, I know we're going to talk about that in a few minutes, but the evidence is there. And the evidence where it is not automatic like that, it's just the opposite. The compound rate of return is something like 3% less per year than if you'd just been in the market. I mean, forget about being the best in the market. Just be the average of the market. So anyway, I'm glad you forced that issue. I like it. Okay, now we go on to number 11, keeping your taxes low. And we have choices as investors today, young people do. They can, in essence, eliminate all taxation, theoretically, in terms of investing for the long term by having all of their money in a Roth IRA, or they can be in a regular IRA, or they can be in a taxable account and pay all the taxes as you go. What do you see there from the calculator, Craig, that will help us?
Yep. And so I wanted to take this opportunity and just briefly talk about the different types of accounts. This is clearly laid out in the book, but you've got a taxable account, which is kind of a brokerage account, where when you sell your assets, you will pay a capital gains tax if you make money, or you could do tax loss harvesting if you lose money. In your IRAs, that is tax deferred. Those are tax deferred accounts. A Roth IRA means that you pay the tax now, and then you put whatever's left over into a Roth IRA, and you're not taxed on that money later. A traditional IRA means that you put the money in now, and you're taxed later at whatever your tax rate is when you pull the money out.
So you get the deduction. It compounds without taxation until you take it out. And the one thing we don't know is when they get that deduction and they get a refund, what happens to that refund? What do you think happens to that refund?
It gets spent. Buy cars.
Yes.
Go on a trip.
Exactly. So in a way, I'm not sure that comparison of the traditional IRA to the Roth IRA is real often, but go on, educate it.
All right, so I'm going to go back to the calculator. Again, I need two screens for this one. And I just wanted to prove a point. It took me a while to get, and so I thought it would be worth sharing here for this audience. If you are at the same tax rate, it doesn't matter whether or not you choose a Roth IRA or a traditional IRA. Okay.
Same tax rate when you retire.
Exactly. So if you put it in at 22% and you take out at 22%, you have the same amount of money regardless. And so I wanted to first prove that point. Okay. So we're going to start with our standard example. Again, I've got it set up here, 40-year duration, $5,000 contributed annually in the S&P 500. So in this one, this screen simulates the traditional IRA, where you're putting your $5,000 in, and that is pre-tax money, and that $5,000 gross. The bottom line here is $2.6 million, which is what we've been seeing the entire presentation. And the next screen is going to represent the Roth IRA. So let's say that you've got $5,000 to invest, okay? And you're at the 22% tax rate. So I'm going to bring my computer calculator up here again. And because you've been taxed, that $5,000 at a 22% tax rate ends up being $3,900. Like that's how much money you have available after taxes, right? So, and to get that number, you do $5,000 times 0.78, right? Which is a 22% tax rate. So you can see, oh, I did 500, but you get the point. We'll add a zero to that. So you have $3,900 that you can actually invest into a Roth IRA. Okay. So I'm going to go put that into the other calculator. I've got three calculators on the screen here. And so instead of $5,000, I'm going to put $3,900 invested every year. Again, this is after tax money. And so that dollar value at the end of 40 years is 2,066,000. Okay. Now that number, of course, is smaller, but you've paid the taxes in the Roth IRA. The thing about the traditional IRA is that you don't own this $2.6 million. You own 72% of $2.6 million. Sorry, 78% of $2.6 million. The government owns the other 22%, right? Because that's your tax rate. And as you withdraw every year, they're going to pull out that 22% of whatever you withdraw, and that'll be taxed as income tax, right? So I need to take that $2.6 million. So 2,649,648. And I need to multiply that by 0.78. And so if I'm in the same tax bracket, we're at the same number, $2,066,000 is what you would have in your Roth IRA, right? So that took me a long time to figure out, and it's been a super helpful lesson. Now, in order to talk about millions of dollars, we can consider a different tax rate when we contribute versus when we retire. We have no idea what's going to happen. We know our tax rates today. You know your tax rate because you're taxed every year, but we have no idea what the tax rates are going to be in 40 years. We don't know what they're going to be in 2022, actually, right? The next year. So if you, for example, you were up in the next tax bracket, which I think is currently 32%, it was 24%, but for exaggerations, let's say that you're in the 32% tax bracket when you try to distribute your funds. In that case, this $2.6 million that you've got in your traditional IRA, the government owns 32% of that instead of 22% of that, right? And so this is where you get your millions of dollars, by being tax efficient. So we take that number, 2,649,648, and we're going to multiply that by 0.68 because you're in the 32% tax bracket, which is 1 minus 32 is 68%, because you own 68% of this. And the amount of money that you have at that as part of this portfolio is $1.8 million. I'm not there yet, but I think being able to diversify a Roth versus a traditional IRA opens up doors that you wouldn't necessarily have in retirement if you didn't start early and choose wisely. I think the advice that I've heard is that if you're in the 12% tax bracket or lower, it's better to invest in a Roth IRA, assuming that in the future you will be making or withdrawing more money as your income grows. But you can see, go ahead.
No, go finish, please.
Yep. So I was just going to say that the difference here is, we're kind of, nobody's got a crystal ball. But the difference here is, if you were in the 32% tax bracket when you retire, you would have $1.8 million compared to $2,066,000. So that's about a $200,000 difference.
So I want to talk about it partly on my experience, having lived at the time when the marginal tax rates were actually 90% at one point, but when I became a stockbroker in the mid 60s, it was 70% was the maximum tax bracket. So young people today they don't have any idea what taxes are going to be. We could have a flat tax system, possibly. Who knows what it might be? But there are a couple things that I think are emotionally important. You talked about people who invested $5,000 in an IRA, that you talked about it being a $3,900 investment.